Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, we're from Group 8. We're going to present the Business Introductory Chapter 15 about financial decisions and risk management. Before we're heading into the presentations, I'm going to introduce our group member. There is Asyh, Puja, Asyifa.
My name is Rio Jupanter.
My name is Khadijah Raihan.
And my name is Faqih.
Next, we're going to tell the learning objective. This is the learning objective in our chapters. Next. The role of financial manager. Financial manager plans and controls the acquisitions and distributions of companies' financial assets. The business activity known as finance or corporate finance typically involve four responsibilities. First, determining a long-term investments. Second, obtaining funds to pay for those investments. 3, conducting the firm's everyday financial activities. And 4, managing the risk that the firm takes.
And next, the responsibility of a financial manager. A financial manager's overall objective is to increase a firm's value and stakeholders' wealth. They must ensure that earnings exceed costs, so the firm generates a profit. The responsibilities of the financial manager fall into two general categories. First, cash flow management, and second, financial control. There are three sources of short-term financing for businesses. First, trade credit. Trade credit is really a short-term loan from one firm to another. And the second is secured short-term loans, such as a bank loan, usually involve promissory notes in which the borrower promises to repay the loan plus interest. These loans require collateral, which can be seized if payments are not made as promised. And the last, unsecured short-term loans, is a borrower does not have to put up collateral. The bank may, however, require the borrower to maintain a compensation balance, a portion of the loan amount kept on deposit with the bank.
Okay, next material is three sources of long-term financing for businesses. First is debt financing. It involves long-term borrowing from outside the company. The most common forms of debt financing are long-term loans and issuing of bonds. A bond is a contract, a promise by the issuing company or organization to pay the bondholder a certain amount of money, the principal on a specified debt, plus interest in return for use of the investor's money. Number 2 is equity financing. It takes the form of issuing stock or retaining the firm's earnings. Both options involve putting the owner's capital to work by selling shares of common stock, and the company obtains the funds it needs to buy land, building, and equipment. And then the last one is hybrid financing. It's the use of preferred stock is a hybrid approach. It has features of both corporate bonds and common stocks. The value of common stock and preferred stock to stockholders and the secondary market for each type of security. Common stock gives investor the prospect of capital gains and dividends income. Common stock values are expressed in three ways. First, par value, the value set by the issuing company's board or director. Number 2, market value, the current price of a share on the stock market. And last one is book value, stockholders' equity divided by the numbers of shares. Preferred stock is less risky than common stock because dividends are paid before common shareholders receive any returns. Both common and preferred stock are traded on stock exchange and in over-the-counter or OTC markets. The process by which securities are bought and sold. Investors generally use financial information service such as newspapers and online stock, bond, and OTC quotation. Investors can then place different types of orders. Market orders are orders to buy or sell at current prevailing prices. Investors can issue limit or stop orders that are executed only if prices rise or fall below specified levels. Securities can be bought on margin or as part of short sales.
Other investment. Exchange Trade Fund, ETF for short. A bundle of stocks or bonds that is in an index that tracks the overall movement of the market. Mutual fund. Any company that pools the resource of many investors and uses this fund to purchase various types of financial securities depending on the fund's financial goals. Hedge fund. Private pools of money that try to give investors a positive return regardless of stock market performance. Futures contract. Agreement to purchase specified amounts of a commodity or stock at a given price on a set future date. How risk affects business operation and identify the 5 steps in the risk management process. Business face both speculative risk, where a gain or loss is possible, and pure risk, where only a loss or no loss is possible. Risk management means conserving earning power and assets by reducing the threat of losses due to uncontrollable events. The 5 steps risk management process requires managers to first identify risk and potential losses. Second, measure the frequency and severity of losses and their impact. Third, evaluate alternatives. Fourth, implement the risk management program. And fifth, monitor results.
Okay, thank you for your attention. And wassalamualaikum warahmatullahi wabarakatuh.